Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, July 16th, 2020. We'll start out here with the broad markets, quick overview there, hit the tech sector, small caps, mid caps, futures, relatively brief update there, and just roll into a few other things that I'm watching where we might see some opportunities or have some opportunities to make money in this market. First is SPY here. This is the SPY daily chart, S&P 500 tracking ETF. Really mostly more of the same. We are above the trading range. We, had a false breakout I mentioned the other day when I had, again, it wasn't a hard line. We had a few reactions here. So if you want to say this is a trading range now because we had that island cluster back there, I mean, that's what it is. We're at the top of basically back to where we were right now and a little below where we were on June 8th. So that's it. So the market won't go up, but it won't go down either. It's just kind of trading sideways now for, what is that, 1.2 months, 27 trading sessions. So that's it. Let's not try to make anything more of that. We still don't have a definitive upside break, even if you want to say of this range. We had a green pop above there yesterday, a green candle. We're right back down to the bottom. So that's it. We're really not going anywhere. The divergences, I'm referring to these negative divergences, are still very much intact. You have equal highs here on prices with your indicators making lower highs. That is the first time that we've had negative divergence, or this whole period here, since before the bottom of the market fell out there. You don't get it often on the daily, and when you do, those are usually pretty good sell signals. Not always, not sell signals, I stand corrected, but indications that a trend change is likely. So that's still the way I favor. We'll see what happens, but again, nothing really new to report there on SPY. Let's look at QQQ, because to me, even though SPY is much more representative of the stock market, much more diversified, it's all about tech. It's all about these market-leading FANG stocks, and they continue to exhibit weakness, which is certainly a change of character. They've been driving this rally up for months now, leading the way. And so they're fairly obviously pretty weak lately, and they're underperforming. Okay, to recap, if you haven't seen anything that I've done this week, we had that big bearish engulfing candles on Monday this week. We did not get confirming red candles, and follow through to that, and here we are. So we're still, now the thing is, I guess the other day, give that one to the bulls, but I said they did not wipe out the candle. You just haven't, the bears haven't been able to follow through on this, and so that's it. So we broke down. You don't have to have immediate red candles. If you do, all the better. But right now we're still well below. We've failed to take out even the midpoint, or about the midpoint of that candle, and that's it. So that's where we are. Here's the level we need to take out. That is Tuesday's low right there, if I could draw a more accurate line. And then you have trend line support just above it. But I think Tuesday's low will do the trick, take us down at minimum for a back test of this, or test of that 242 level in QQQ, and that's about another 6% below. The fact we have, a bearish engulfing candle as well as negative divergence on the NASDAQ 100 as well, and many of those FANG stocks also says, hey, 6% might just be the first leg down, because this is potentially a trend reversal, a topping candlestick. So and then maybe a 6% drop. Sometimes you get that, but it could also lead to more. So I'm very open, but just eager to see what happens. We don't have much resolution today. The tech stocks were down, their Qs were down about 0.7%, but it doesn't change anything technically. We're still below that bearish, but not below Tuesday's lows. Tech, like I say, it's all about tech, and that continues to exhibit weakness. There are 11 sectors in the S&P 500, with technology being the largest by far at about 25% weighting, and it was the weakest sector today, down 1.24% on the day. And like QQQ, because they nearly mirror each other, you had a bearish engulfing on Monday. You didn't have any confirming candles yet, and we're here. What I'm going to do is tweak this trend line. We're pretty much closed on the trend line the way I had it drawn, and at this point I think we can move it down here. Let's just modify it a little bit, and I'm referring to this purple trend line. It comes off the low of the candle back on April 6th, and what I've done there is come in to try to capture, let me move it a little tighter, you can see it here, this reaction low on that candle, that reaction low, now we're just above it. Either way, we also have the price support just above it, about 103.87, and then 101.79 or 101.80 So we just need, same story. I have that 103.87 because that is the low from Tuesday. That's the level I think we need to take out to start some impulsive selling. So it's still anybody's game right now, but again, the negative divergences, if it was in a vacuum and I couldn't see all the lines, the divergences, all that, I'd say 50-50, whether or even better in an uptrend. The odds favor a continuation of the uptrend normally, but when you start putting all these lines on the charts, these are what tell you that the momentum is waning in the trend, and that a trend reversal is likely soon, and hence that's why I'm still leaning that way to the downside. Quick look at the stock futures, particularly NQ, and what I'm paying more attention to right now. I have this sort of a broadening wedge pattern. Certainly have a trend line there, and this is a divergence line. It's a little wedgish, broadening wedge, more so than a rising wedge. Breakdown there, as I mentioned, we reversed right off that support level with a small divergent low, small divergence on the RSI, came up, back tested, and we rolled over. Actually, we're picking up where we left off this morning, right there at that 10.508 level. I told you this morning, I believe, we need to take that out. If and when that goes, that's our next sell signal. We didn't take it. We just kind of traded sideways all day. So really not much to update on the broad markets from this morning. Same thing holds. Next sell signal coming to break above 10.508 or so. A solid break, 60-minute close, not just a little intra-period dip below. And then that will take us down, I believe, to ultimately, I think down here, right around that 10.107 level. That's still what I'm looking for if we get that breakdown. Again, at bare minimum, because remember, there'll be some, if that happens, then it's going to firm up those sell signals on the daily chart, which might open the door for a much larger move. And what would that mean? Well, I can tell you just generally, rough eyeballing this chart right now. I'd have to study a little further. I think somewhere in here, might have become a little low on that trend line, somewhere around there, 99.42 if things get real ugly. And then max target at this point in time, about 95.54 right there. What would that mean if we did it? It'd be about almost a 10% drop if we got to that current max target. I say current max target because the charts are dynamic. If we start to go down there and we start to smash through support levels like they're not even there, get additional sell signals, see more market leading stocks break down, well, that might open the door to more. Otherwise, maybe we burn through all these recent bearish developments, which would basically be just taking out the top of those candles that we had recently. And like I said, it's not going to eliminate the bearish case, because you're still, if that were to happen, you're going to put in just at any point soon. It depends when it happens, but if it happens soon, you're still going to just extend the current divergences that are in place. So in other words, I want to make clear that to me that's not okay, everything's now bullish, go long if you pop that recent high. It doesn't mean go short it just because you have divergence, and it's certainly going to chip away at the bearish case, but again, it won't eliminate it. S&P 500 futures, again, I've talked about it. Broad market's gone nowhere for over a month now. You sort of have a megaphone pattern, broadening wedge pattern there, divergent high in place at the most recent high. There's your negative divergence, actually, from that point to that point as well. There's your negative divergence there. So we're not going down, but we're not going up either, at least since this point. It's been choppy since then. But again, that's resistance right there, that previous reaction high, pretty big resistance level. And you could almost draw a trend line like this as well to watch. Flip back to the Qs. Let's take a look at what's hot, what's not today. So I'll sort these by percentage change. All I can tell you, first of all, I want to take a look at breadth today. Now, obviously, you would expect negative breadth because QQQ was down today. So if I click here, this is how I calculate real-time breadth at any point in the day in the market. I just go to sort of watch list of the components of an index, and it tells me that today 33 out of the 101 stocks in the NASDAQ 100 closed positive. That means the rest were all, well, KLAC was flat, the rest were negative. So, and that about jives with what how much we were down in the Qs. The best performer was KHC. KHC was one of the few index, one of the few QQQ and major index components. I believe it's also in the S&P 500 that I was actually quite bullish on back here in April, May. I think it was May. Covered a few times in the video. Broke out above this primary downtrend line, multi-year downtrend line. So I said that's a nice growth and income trade. Pays a decent dividend, about 5% dividend, and they should be reporting soon. Let's see, they reported last on April 30th. But again, that's what's moving up. Things with constructive charts. So some stocks. The point here is that some things can buck the trend if they have bullish charts. Now, I wanted to update it also because it's come to that level, that 36.61 target. A big old gap right here. Actually, technically, the top of the gap's way up here, and the bottom of the gap is right here. But the thin zone, really, I like is from this point down to this point. So is it going to take that and rip through there? Not if the market goes down, most likely not. But again, one of the better looking stocks is a potential bottoming play. It is peeking into that thin zone, but not clearly up in there yet. Just wanted to update it. Since the breakout of the downtrend line, it's already gained about 22%, and not including the dividends paid. So longer term target, if you're in this one, still remains any or all of these targets up here that I have right there. And that's it. If it pulls back, probably come back to the bottom of this recent range here. About 29.89 would be your next objective buy point to add to it. And then again, a solid break up in here, especially if the market's holding up at the time, then that would likely open the door for a backfill of that big thin zone up there, probably 20% or more till that gets filled. Okay, so that was the best performer in the NASDAQ 100. If I click and sort here, worst was NetEase, and you can just look at what's going on here with a lot of these tech stocks. Again, of course, KHC, it's in the NASDAQ 100, but it's not a tech stock. A lot of these tech stocks, have put in some pretty bearish price action recently, whether they put bearish candles or they're just coming down pretty hard. And you can see you have a common theme. A lot of these are just skirting right now, testing, at least this one, trendline support. TCOM, I don't have that chart marked up. Expedia, some of these are lag. Zoom, I mentioned Zoom. I told you I'd keep it on my radar. Day of reckoning is coming for this one. Yeah, great, everybody doing video conferencing, but a little too much, a little too fast. Plus big divergence, negative divergence, overcrowded trade. I think 243-ish needs to go right there. Minimum target, probably get a bounce off the trend line. And there's also, I don't know if you can make it out under there, the 50-day moving average. This one seems to ride up pretty well. I'll turn it up a little so you can see that yellow line. It's capped. Pretty much capped the entire advance since this one started to take off, around the time of COVID. And that comes in perfectly, or almost perfectly, with my uptrend line. So there's a more powerful sell signal if the 50-day and that trend line are taken out. Minimum target, if and when that happens, 181. And you can get a jump on it, I think, if 243. You want to be safe, say 240 goes with conviction. That would be, I'm trying to measure it out because there's a lot of meat on the bone on this one. To get down to that minimum target there, about 27%. All right, so that's Zoom. Let's see what else. Tesla, I considered adding it as short the other day, but it would have been just a gut shot. It was on this day here. I didn't do it because we really didn't have anything close to a sell signal, but it's been moving lower since, and I think this one's just way, way, way ahead of itself. Like I know a lot of people do. I know it's very heavily shorted, and that's also what this is. I think this is probably a big part of a short squeeze here. So remember, when they report short interest, the problem with short interest data is they take the readings only twice a month, bi-monthly, and then there is I believe it's 10 days after that, so it's almost 11th day, end of the 10th day, where they have what they call the dissemination date, where they actually report it. So what you're getting is it was very dated information. It can be almost 2 weeks old by the time they report it. So all I'm getting at is if you look at a stock that's heavily shorted, and if you see a big move like that, a lot of times that's cleared out a lot of the short interest. A lot of shorts have capitulated. So where does Tesla go if and when the market finally cracks? 94.55, so about another 36% downside minimum. If it breaks that level, probably head on down here to 678.92, or roughly call it 680. Okay, and then a couple other opportunities. Again, the ones that we're in now, recently shorted. Nothing but red candles so far on Adobe since the breakdown. Still looking good. Not to the first target yet, but still about halfway there. And then of course PayPal as well. needs a little more work. PayPal, like the market, I'd like to see it take out Tuesday's lows, but still very much like it. And again, the point is that these guys have already broken down, as have quite a few other stocks in the Nasdaq 100. Some of the market leaders are starting to show cracks. One of my favorites, as I mentioned this morning, is Amazon. Favorite if you don't want to short anything in the fangs. Big bearish engulfing candle on Monday, along with the market and a couple other fangs. Wiped out 2 days, engulfed the previous 2 candles. Nothing but red sticks so far. Took out the trend line, and I really don't see anything much in the way of support until that yellow uptrend line. It will come in, probably intersect with this little reaction eye here. So that's probably about another. Depends on when it gets there. If we hit the trend, let's just go for the trend line now. Say that'd be about another 8.5% on Amazon. So if that happens, no guarantee it will, but that will most likely take the market, the Qs and the tech sector. Although actually this one's not an XLK, believe it or not. A lot of the fangs are no longer considered tech stocks. They put them in the communication sector. Or in the case of Amazon, in the consumer discretionary sector. Which makes sense too, what they're selling online. 1/4 of this sector is Amazon, so pretty much XLY. If you think you're diversified, you're not. You're going to be subject to whatever Amazon does. If Amazon breaks down, drops 20%, XLY is going to go down, give or take 20% with it. Divergent highs I just marked there for you. I don't know why it's not here on the chart. This board doesn't have it, but there's your negative divergence right there on XLY. Broke out recently on, what was that, Tuesday, I think? No, that was Monday's candle. And so far, holding above that breakout. What I'm referring to is the previous the previous all-time high right there. Checked it there, couldn't take it. Tried, finally broke out. Failed that day. Came above there yesterday, but this is not a very impulsive or convincing breakout. Maybe it'll stick, but as I often say, breakouts that occur both with overbought conditions as well as negative divergences have a much higher rate of failing than breakouts that occur without those conditions. So there's what I'm looking at on XLY. If the breakout fails, minimum target, I think we come back to 123 right there. One place that I continue to think has some of the worst risk reward of any security out there is our Treasury bonds. Fed is just they've taken rates to zero, which means if you understand how Treasury bonds work, their prices are solely determined by interest rates. Credit quality, if that ever becomes an issue, but USA is usually AAA rated. So those are the two things that impact bond prices: the credit quality of the issuer, if it gets upgraded or downgraded, or interest rates. So really with treasuries, it's really interest rates. We know the U.S. always pay its bonds back, even if they have to print more money, which they're doing, or print more bonds to do so. It's basically a Ponzi scheme. You can always print more money and keep doing it until that gig is up. And that's the risk, is of course at some point maybe it won't be inflation that causes rates to start spiking. Maybe it'll be that other countries just decide to stop buying our bonds because we're going to print our way out of paying for all the stimulus that we continue to inject into the system. So point being, that's why you hit a ceiling here. It's part of there's no price discovery anymore because the Fed has a heavy hand in manipulating the bond market, and rates are near zero. So if they don't, unless you went to -5%, -10%, there's effectively no more upside. And I'm not literally, but effectively no more upside in Treasury bonds. So there's a trend line. So you're looking for a short. If you short bonds, they pay interest. When you're short anything, you have to pay the dividend or the interest on it. In this case, it's an ETF, so you're going to have dividends, but not a one that I'm recommending or suggesting as a short now. Just one that if you're in it, realize that 99 times out of 100 in the past, you should have, depending on your age and how close you are to retirement, all that kind of stuff, risk tolerance, should have some money in Treasury bonds. I think you're better off in cash right now. That's just me, because again, you have very little upside. They pay next to nothing, and the downside risk is huge if and when rates start to go up. So where to make money, other than I did the extensive video on gold today, gold, silver. I laid out quite a few trade ideas. We closed out the gold trade, booked 20-something% profits on that, and lined up. Looking like the next move in that sector, the next big tradable trend will be to the downside. So I'll continue to follow up with individual trade ideas on the individual gold and silver mining stocks. I went over a few today, as well as all the ETFs, gold, GDX, Nugget or Dust, SIL, the junior miners, seniors, and all that stuff. Commodities too. I still think the risk reward is more attractive on commodities. Recently the trend on most of those have been bullish, so I still like that sector. Some pull back today. That's an objective time to buy. Add into these. Like the grains, JJG. If you want one that fits, one size fits all for corn, soybeans, and wheat, you can buy this ETN. And I talked about it yesterday. Yeah, some of these are not actively traded. Split the difference on the bid and the ask, or use a IB algo order if you use Interactive Brokers, or any other broker if your broker has any type of orders that are meant to do that, deal with less actively traded stocks. But as I said, these things are going to track the commodity, so it's not like buying a penny stock that's a liquid that you may get trapped into and there's no way out. If the grains go up, this thing is going to go up, unless for some crazy reason any of these ETNs blew up. But the grain and agriculture commodity ETNs that I highlight on these trade ideas here are not leveraged. They are ETNs, which is a little bit different from an ETF. An ETN is basically an IOU from a bank that's promising to pay, or the issuer, whereas an ETF is a little bit more, it's a collection of all the individual securities. Like QQQ is really just made up of the 100 stocks in the NASDAQ 100. Essentially, it might use some derivatives to get that effect, but it's an ETF, a little bit more secure than an ETN just by nature. And of course, there's always futures. If you don't like ETNs, you don't like the liquidity, there's futures. This is CC, Cocoa, coming off that divergent low I mentioned recently. Had this thrust up, pulled back. Looks like it's headed up for this next target, about 2209. I'll probably get a reaction there and continue on up to that next target around 2305. Or you can, if you don't like futures, don't trade them, don't have a futures account, don't know how they work, of course, read up on them. NIB, Cocoa ETN. Again, it was just highlighted recently, pulling back to this multi-year uptrend line coming off the 2017 lows, and divergent low there. So those are some of the things I'm watching today. And let me see what else. I think that's it for this video. We'll wrap it up here with XLC. Remember, XLC is one of the largest sectors in the S&P 500, but it's made up mostly of Facebook and Alphabet. Those two alone account for 44% of that sector here. And this is the sector ETF, XLC. As you can see, same thing we had back here into the big drop into the March lows. We have negative divergence, even a larger divergent high right now. Trend line is actually similar. I had this one drawn like this. If you try to bear with me here, if you can make that out. I guess it's the nature of this sector. We had a nice clean trend line here, and just before the top came in, we had a whipsaw, false breakdown. So a bear trap, whatever you want to call it, whipsaw signal, pushed on up, then put in your divergent high, then the next breakdown was a real deal. Here, this is the trend line I've been tracking recently, broke down and back tested here to put in another divergent high, and even a little brief pop above it. But like everything else, you had the bearish engulfing candles on Monday, and we came up to about halfway through that candle, maybe a hair above, well, closed about halfway up. And so this one, that's it. We need to either, the bearish case, you'll need to see this sector break down or the market's not going to go down. You need to see this one come back down into that recent trading range and make this a fake false breakout. Otherwise, the bulls are going to win. If they can, keep this breakout intact, trying to box it in right here. Well, it already failed. What am I saying? The breakout already failed right there, but now we're back above it at this point in time. So we need to move back down in this range, let these divergences play out, and of course that would entail Facebook and Alphabet rolling over. So that's where we'll leave it. This all really has to do with tech and these FANG stocks. If they're not technically tech companies anymore, like Facebook, for this, for all intents and purposes now they consider it a communication stock, and Alphabet as well. But they're all big tech. That's what walks like a duck, talks like a duck, or quacks like a duck. That's what it is. And so we need to see those guys break down. or more of the same. And so if they, if we don't get the breakdowns, I don't think it's prudent to add to any short positions until we do at this point, or at least not get aggressive. I'll just continue to fry the better fish elsewhere, whether that's gold stocks, silver stocks, commodities, or any individual stocks that stand out with clearly bullish or bearish chart patterns. And I'll continue to try to find some more longs. I know a lot of you out there probably don't short, so I'll do my best to see if I can come up with some longs that kind of fly under the radar, aren't very heavily indexed. So if we do get a correction, they might be able to power on up while everything else is falling. Let me wrap it up here and get this out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.